Hello everyone. In this video, I am going to talk to you about how you can determine a project's cash flow from operations, or the cash flow that is generated from operating a specific project. So here's the context. We know that whenever we are evaluating a project, one of the key ingredients or one of the key things that we need to know is what are the financial cash flows or free cash flows that we are expecting to earn from the project. And in a previous video, I have explained to you how you can think about these cash flows as basically composed of two main steps. Like if you want to determine the financial cash flows, you want to get a sense for A, what am I going to get from operating the project, which is cash flow from operations, and then B, how much is it that I'm going to have to spend to get this project going, which is basically captured by your long-term investments or your capital expenditures. Or sometimes in order to get a project going, you'll have to spend money on inventory or maybe generate accounts receivable, and all those investments of cash will be captured by changes in net working capital. The objective of this video is to just focus on the cash flow from operations part. Like if you wanted to figure out how much is it that the operations are generating and just the operations portion, how would you go about doing that? Now, in order to see how this calculation is done, it is perhaps useful to first recall what a basic structure of an income statement looks like. So this is a very basic sort of a structure for an income statement. You start out with sales, you subtract costs. These are your operating costs. So these will include something like cost of goods sold. These will also include other operating expenses like utilities and wages. But then you will separately subtract depreciation and sometimes depreciation and amortization. The reason why we distinguish between these costs right here and depreciation is that even though both these costs are operating costs, depreciation and amortization happen to be non-cash costs. So these are non-cash expenses. No cash actually leaves the business when you are subtracting these. This is very, very important. So on an income statement, you'll have the sales, you'll subtract your operating costs. You can, for convenience, refer to these as cash costs because some cash at some point does leave the business because of these costs. When you pay for utilities or you pay wages or whether you pay for your purchases, cash actually does leave the business. But with depreciation, that's not the case. It's a non-cash expense. So that is the distinction between EBITDA and EBIT. EBITDA is basically the earnings before you pay off any interest, taxes, depreciation, and amortization. Once you subtract depreciation, then you get earnings before interest and taxes. After that, you have your interest expense, which as we know is a financing expense. It's not an operating expense. So this is a financing expense. In other words, it is there because you chose to finance your operations using debt. That was a choice. It's not driven by operations. It's more a function of your choice about how you decided to fund your business. So this is a financing expense, which is separate. And so now this yields our taxable income, which if our flat tax rate is 21%, once we deduct that, that will give us our net income. So this is a very basic, very basic structure of an income statement. So now let's suppose you're considering investing in a project today, and next year you're expecting the following figures from this project. You're expecting this project is going to generate some sales of $1,500. You have some cash costs like cost of goods sold, utilities, wages, etc. You're expecting these to be $700. So your EBITDA is $800. And let's suppose that you are also expecting depreciation expense of $600, which yields an EBIT of $200. Let's further assume that you're going to be funding this project partly with debt. So you will have some interest expense, which is a financing expense. So let's suppose that's going to be $50, which means that next year you're expecting your taxable income to be $150. If your flat tax rate is 21%, this means that you are going to have taxes of about $31.50, which means that next year you're expecting net income of about $118.50. Now, our objective is to figure out how much is the cash flow from the operations of this project that we're expecting next year. It's important for you to understand that what this table is giving you is the net income that you're expecting from your project next year, but that's not what we're after. What we're trying to understand is how much is the cash flow that we're going to get from the operations of this project. Now, the first, perhaps most important step that you need to take in order to do this calculation is to ignore interest expense or financing expense. As we just said, financing expenses are not directly related to operations. They're more a function of how you chose to finance your operations. We don't want to taint our measure of cash flows from our project's operations by how they are financed. In other words, we want to assess the cash flow earning potential of our operations based on what they're earning before we pay out any other expenses that are related to how those operations are financed, because we just want to assess the operations. To give you an example, if you compare like a Ferrari to a Hyundai, on any given day you will say, Ferrari is better than a Hyundai. It's got more horsepower, it's more stylish. So all the characteristics of a Ferrari are just better than a Hyundai. Okay. Now, let's suppose that there is one guy who takes on a whole lot of debt to buy a Ferrari. Now, if this guy comes out and says, oh man, I don't like a Ferrari because it's making me bankrupt and I have to pay all these high, these lease payments, well, that's not the Ferrari's fault. You still want to be able to say that a Ferrari is better than a Hyundai based on the attributes of those cars, regardless or independent of how they're financed, right? And so the same argument goes over here. And this is often a major confusion for students. Students will say, you know what? When I pay interest expense to the bank, that's money leaving my business. So how is it that I'm not accounting for interest expense as one of the things that's draining my cash flow? Well, we are not saying that interest expense is not relevant. I want to say that again. We are not saying that interest expense is not relevant. What we are saying is that interest expense is not relevant for measuring the cash flow earnings potential of your operations. How interest expense will play a role, that will come in later. But for now, we want to say that when we are trying to measure the cash flow earning potential of our operations, for that part, we don't want to consider interest expense because it's a financing expense. So, in order to measure our cash flow from operations, then we basically work off of this income statement, but we sort of reorganize this or make use of this as follows. We basically rewrite all the figures up until EBIT. They remain the same. So up until here, we say, look, we have earnings before interest and taxes of $200. So that's all fine. That's basically what we had originally. However, now we're going to pretend as if there is no interest expense. In other words, let's assume that there is no debt. Again, the reason why we're doing this is because we don't want to taint our measure of cash flow from operations with something like financing expenses. So the way we do that is by pretending as if there is no financing expense like interest expense. So we assume or pretend that interest expense is zero, which means that our taxable income comes out to $200. Now, I want to be clear, this is not your actual taxable income. Your actual taxable income next year is going to be $150, but we are doing something else altogether right now. We're trying to measure cash flow from operations. Therefore, in order to do that, we're pretending that there's no interest expense, which means that this taxable income, I'm going to call this our unlevered taxable income. Unlevered means that this is the taxable income that would have existed if we had no debt, if we had no financial leverage. So this is $200. We're going to then pretend that what were the taxes, or what would have been the taxes that we would have paid if this were our taxable income. So these taxes I'm calling my unlevered taxes, which charged at 21% is $42. And so if this were the case, then the net income that we would have gotten would have been $168. I'm not calling it my actual net income for next year. That is what we saw in the previous table. This is what I'm referring to as my unlevered net income. In other words, this is the net income that would have existed if there were no debt in the picture, if financing expenses were in fact equal to zero. Once you've accomplished this, then the calculation of cash flow from operations is actually fairly simple. So I'll abbreviate cash flow from operations as CFO. Sometimes you'll also see the abbreviation as OCF, which is operating cash flow. Same thing. So the idea here then is this. You're trying to get a sense for, hey, if I'm going to be running my operations, what is going to bring in cash and what is going to drain cash? Okay, let's talk about how cash is going to come in. Well, the cash is basically going to come in through the sales that you're going to make. So sales is a source of cash. Now, some of you might be thinking, wait, what if these sales are on credit and I generate accounts receivable, so I'm not seeing any cash? Well, we're still accounting for those sales as cash sales because at some point you will see cash for those sales coming in. So that cash doesn't have to be immediate. It just needs to be coming in at some point. So this is our source of cash. We want to subtract cash costs. Cash costs. Costs that take out cash. And this is the important part. There's some costs that you have which are cash costs, like utilities, wages, cost of goods sold, but then there are non-cash costs like depreciation, and we do not want to account for those over here because they don't drain cash, right? So cash coming in, cash going out. The one final source of cash drainage is going to be your taxes, the taxes that you pay. And in this case, we've calculated these taxes in a revised form by calling these unlevered taxes, which are the taxes that you would have paid were there no interest expenses. So we're not going to take the original taxes that were in the original income statement. This is the main reason why we did all of this sort of redesigning, is because we wanted to ignore the interest expense and then see how much our taxes are going to be. So these taxes need to be your unlevered taxes. This is very important. These taxes are the taxes you would have paid had there been no interest. And again, we've gone over sort of why we're ignoring interest expense for the time being. And so now when you do this math, then your sales are $1,500. Your cash costs based on this table are $700. We're not going to subtract the depreciation, but we are going to subtract the taxes. And the taxes here are $42. So if you do this math, your cash flow from operations is going to come out to $758. And so this is how you can determine the cash flow from operations for your project. One important thing to bear in mind in this calculation is that even though depreciation is a non-cash expense and is therefore not getting subtracted in this portion of the calculation, it does play a major role in influencing our cash flow from operations. Why? Because if you notice, the taxes are basically imposed on our earnings before interest and taxes, and our earnings before interest and taxes does depend on depreciation. Put differently, our EBITDA is $800. When we subtract depreciation of $600, that lowers our EBIT to $200, and therefore the income that gets taxed is $200. Basically, depreciation saves us taxes. Depreciation expense helps lower our taxable income, which in the end influences how much we end up paying in taxes. And to the extent that taxes are a source of cash outflow in our calculation, this portion right here is being influenced by non-cash costs like depreciation. And so you will often hear that people say, oh, you know what, depreciation offers a tax shield. Well, basically what they're saying is this: depreciation helps you pay lower amounts in taxes, so you get shielded from the taxes that you have to pay. And now you can probably see why, even though it's a non-cash cost, it helps reduce your taxable income, which then helps reduce your taxes. So the last thing that I want to say about this calculation of cash flow from operations is that this same expression, this sales minus cash costs minus taxes, there are different ways of writing this exact same thing. So you might see different formulas for this exact same expression. They all accomplish the same thing. They're just different ways of writing the exact same formula. To make my point, this is what I'm going to do. I'm going to use the symbol S to denote sales. I'm going to use the symbol C to denote costs, which are just cash costs. The non-cash costs, that is depreciation, I'm going to use the symbol D for that. And so our baseline formula for cash flow from operations is this. We say that you take your cash sales, you take the costs, which is just the cash costs, so just this guy, and then you subtract the taxes, right? Now here's the thing. Your taxes are basically a function of your taxable income. And your taxable income, in the instance when you have interest equal to 0, then your taxable income and your EBIT is exactly the same, and your EBIT in turn is the difference between sales and costs and depreciation. So what I'm saying here is that your taxes are basically equal to, you take your S minus C minus D, where D is your depreciation, and basically all of this is sort of your EBIT, which is also, in the instance where interest is 0, is also your taxable income. And what I'm saying to you is that your taxes are basically T times all of this, right? So the exact same expression, like sales minus costs minus taxes, can be written in this form. And again, notice that depreciation is helping reduce your taxable income. Now here is what I'm going to do. I'm going to do a little bit of algebra. I'm going to subtract D here in this expression, but then I'm going to add D, which is depreciation, separately towards the very end of this formula. It doesn't change things because you have minus D and plus D which sort of cancel with each other, so it doesn't really change anything. However, the usefulness of this formula now is that you have S minus C minus D here, and you have S minus C minus D here, appearing with the symbol T. And so you can take S minus C minus D, which is the common factor, which means that now you're left with 1 minus T, right? So this is basically all of this guy, right? So S minus C minus D is this guy. And because you have the same thing here, I've taken this expression as the common factor, and basically then I have 1 minus T. So this expression basically is all of this. But hey, you separately have depreciation over here as well. And so notice that this is basically, like we said, this is EBIT. And so what you're really saying is cash flow from operations is actually EBIT, which is earnings before interest and taxes, multiplied by 1 minus T plus depreciation. And so this is another very common way of expressing the formula for cash flow from operations. It's derived from the same thing that we just did. Sometimes this is referred to as the bottom-up approach to calculating cash flow from operations, because you are starting at the bottom, which is like earnings before interest and taxes, and then you're moving up and adding depreciation. And so this is one way in which you can calculate cash flow from operations. There is yet another way that you can write the exact same thing. So notice that we just established that cash flow from operations can be written as EBIT, S minus C minus D, all of this into 1 minus T plus the depreciation. This is just the formula that I just showed you. Well, let's, again, a little bit of algebra, but bear with me. What if we do this? What if we take this S minus C part and multiply this by 1 minus T separately? So you do S minus C into 1 minus T, and then you take this D part and multiply this with 1 minus T separately. Basically, you've opened up the bracket. So I'm still writing this exact same thing, only now S minus C is getting multiplied with 1 minus T separately, and this minus D is getting multiplied with 1 minus T separately. Of course, I still need to account for this depreciation or this D over here. What's the benefit of this? Well, this is just sales minus cash costs, right? So this is like cash sales and cash costs. And you're saying what is going to be left on this after I've paid the taxes. And so I'm just going to write this guy just the way it is. So S minus C into 1 minus T. But now notice this part, if you sort of open up the brackets, minus D gets multiplied by 1, so that's minus D, plus minus and minus gives this plus, and then D times T, that's TD, and then plus D. And notice that here you're getting basically this D cancels out with this D, and so what you're left with is sales which are cash sales minus cash costs, you're basically saying, if I just had these, what would I get on, what would I be left with after I've paid taxes on these cash sales and cash costs? Oh, by the way, I will also get T times D, where this T times D is my depreciation tax shield. So the idea here is this. What we are saying is that, look, if we just account for the cash sales and the cash costs that we have from our operations, and then think about how much we would pay on taxes on those, then this portion is capturing how much would be left behind after we've paid taxes on just the cash sales and just the cash costs. However, depreciation helps reduce our taxes, so we get another source of cash based on how much we end up saving in taxes on our depreciation expense. And so T times D is exactly capturing how much we would save in taxes because of our depreciation expense. Hence, that's another source of cash flow, or is our depreciation tax shields. And so this then sums up our discussion on A, how we measure cash flow from operations, where the important point was that we don't account for financing expenses. And then B, we saw how we can calculate cash flow from operations using different formulations.